button. So let's see if that's happening. Webinar is now live on Facebook. Andy, hey buddy, good to see you, mate. Welcome back. We've been MIA for a week or so, but welcome back to another Wine and Wisdom, my friend.
Welcome, mate. It's good to see you. Good to see you smile on the face, and welcome to another week of news.
Mate, awesome to be back in the swing of things, mate. While we're getting set up, I'm just going to have a bit of a log in, make sure we can see the questions potentially from those who might be logging in to Wine and Wisdom today. Hopefully we've got a few people jumping on. I saw a few of the team keen on jumping on this morning. So for those who are here already, I can see a fair few. Welcome along to the Wine and Wisdom live. For those who are joining us for the first time, quick intro. Jason Witten's my name, Andy Fenton on the other side there. Equities extraordinaire, banking and all things shares and the stock market. Andy's world of 20 plus years of experience, and my world of real estate investing, the Australian property market, a little bit of New Zealand, but mostly Australia over the last 20 odd years. And Andy and I get together on a Friday, most Fridays, other than the last Friday, to have a glass of wine and then share a little bit of hopefully wisdom from both of our camps, both of our worlds of investing and marketplaces, to see if we can't, help each other out and learn a few things from each other that gives our decisions, our world of investing, maybe a little bit more perspective in the world that is COVID or post-COVID or mid-COVID or whatever it is right now. So welcome to those who are joining us for the first time.
Hey? We're just going to call it the world now.
The world.
I'm sick of these terms of the new normal or all of these things. What is the new normal? Well, the new normal is the old normal. So
it is what it is right now, isn't it? And that's the way we're rolling. So
absolutely.
So anyone who's dialed in, good morning. Or good evening, not good morning.
Good morning. Jason's coming to you from China now.
I'm a little bit off the pace, but we've got a few people dialed in. Shay, which is my number one supporter, my lovely wife, Brenton Ward, and a few other people watching. So welcome, gang. For those who are dialing in, if you've got any questions, you've got any feedback, chuck it in the chat. We can see it for tonight's conversation. Chat somewhere, wherever that is on the live. But, happy to answer any questions as we roll along. But usually what we do, Andy and I, to kick off the start of Wine and Wisdom, we talk about some of the information. Oh, there's Jason O'Neill joined us. Thanks, mate. Good to see you, brother. We just talk about a few things that are in the news and just give a little bit of our opinion and feedback on what's going on. Andy's going to be talking about the world of stimulus or maybe the potential ending of stimulus when it comes to, businesses and other bits and pieces and some of the things and how that might affect, the world of marketplaces. So, mate, why don't you give it a bit of a whirl or maybe a little bit of a highlight of what's going on in your world, Andy, in the world of the stock market, the equities market, from an investor's point of view. There's Nicole as well. Hey, Nicole, good to see you.
Well, hey, everybody, and welcome in. We've become a little bit of what we call peripheral visionaries, and I like to think that we're peripheral visionaries. We can see into the future, but sometimes just way off to the side. But at the moment, we're actually making a lot of right calls if you've been following Wine and Wisdom for a little bit, and it's not unexpected in my world, but what I want to do is share a couple of the insights that we told you were coming some time ago. And I'm going to talk about business and markets, and we'll chat a little bit about why. It's less in the news other than, well, we're making the news right now. So probably better to listen to people on the forefront than a whole lot of people who are reading off teleprompters. But a little while ago, we talked about markets and we talked about the stimulus, and let's just call stimulus the government pushing money into the economy by way of either your tax relief, because remember, it comes via giving you money, and stopping you from having to pay money, which ultimately means more money in your pockets. And it was one of the great confusions of business owners when the government came out and said, we're going to give you X amount of money. And it was like, well, we're not going to give you that. We're just going to stop you from having to pay that. And basically what Jason and I talked about and said a little while ago was equity markets are going to follow certainty. And equity markets don't like uncertainty. And so what was pretty certain over recent times is that markets were going to follow and be driven by stocks that had a definite resolve to them. So let's have a look at the big market players, right? Who crushed it? Tesla bucks the trend on this, just by the way, for any of the people who are going to call me out on that, because we've talked about Tesla a lot. You can go and get to tonight because they're a trend bucker. Right.
I'm buying Tesla, Andy. Tesla and Apple. I'll buy it whether it's up or down. But anyway, keep going.
I've held you off. I've held you off for a little bit, and since I've held you off, they've dropped about 20%. So allow me just to hold those reins in a little bit, and let's just allow their valuations.
Well, there's the value of a good advisor, gang. You know, I've been like a bull at a gate to buy some shares, and Andy said, "Hang on, Jace. You know, I reckon there's a better buying opportunity coming soon." And anyway, keep going, brother. I'm glad you're in my camp.
Right, just holding the reins, and then we'll go berserk. And it's a great theme because you get to box on. And the beauty about markets is that they're emotional. Now that's what they are. Because they operate instantaneously. Like nowadays, one of the biggest queries Jason and I've had in the last week and a half is trying to decide on what trading platform we want to use in order to create the Wine and Wisdom investment fund, which is whereby we put our money behind our mouths with some of the stocks which we talk about from a week-to-week basis. Not for any particular reason, just to probably long-term see whether we're right or wrong. And because there's so many different platforms to choose from, you've got eToro, you've got NabTrade, you've got ComSec, you've got international tradings, you've got Stake, you've got all these different platforms that are now allowing you to trade anywhere in the world effectively for minimal margins. And what that allows is it allows the psychology of your average person to creep into the valuation of companies. And let me let that land a little bit. The psychology of your average person to dictate what the valuation of a company is.
Yeah.
Right. So when we're stimulating, right, when we're positive and when we believe that things are going in a certain direction, then we're happy to buy. Jason, beginning of COVID, what are you going to do with your time if you didn't own your business?
At the beginning of COVID, I don't know, mate. Well, maybe I would sort of, if I didn't have to go to work, I'd be sort of hunkering down at home and doing nothing, right? I mean, I don't know. Like I'd be.
So what are you going to do to pass the time?
Yeah, well, I'm going to shop online. That's what I'm going to do. I'm probably going to be on my iPad, and I'll be seeing things like, yeah, I need one of those. I'll be ordering my food on Uber Eats or online shopping. Yeah, well, which is what I've done anyway. Gee, I can tell you, like the old online shopping, the old online Ubers had a good belting. That's for sure for me. So yeah, I mean, which companies are receiving those benefits?
Buying shit that you can't afford. That's another one. Afterpay. Watching stuff that you don't know that you're paying for, which is Netflix and Stan. In a world that was very uncertain, there were things that were very certain, right? And that was our trends. 1 week into this, and the world knew we were getting on Netflix. So those people who are interested in Netflix were buying Netflix because they could buy it on their eToro, they could buy it on all of these things.
Yeah, we should have got on that one, Andy. Like, what did we miss? Like, that would have been a goodie, right? Yeah, was it? Or is this
nowhere
a tale of woes or not?
Nowhere near as much as we missed in Tesla. But let's put it this way: Apple went from $1 trillion stock to a $2 trillion stock before the COVID. It hit $1 trillion. After COVID, it hit $2 trillion market capitalization. Right. So there was a degree of certainty during a period of time which was largely irrational, and we call it irrational exuberance. And that's where you're taking tips from the taxi driver. But so here's the thing. And I want to show you this from an Australian perspective, because some of you will have seen this from before. We talked about the stimulus and how the stimulus is going to end, or how
we've got a few people here logged in, Andy. We've got Nicole, Christopher, and Jace. You know, Lino sort of said, "Hey, Afterpay shares have skyrocketed since COVID." So, mate, you know, there you go. You're dead right.
Some of the biggest names, right? And we picked a lot of them early. We mightn't have put the Wine and Wisdom Fund to work, but we certainly talked about them. And the fact that we were talking about them means that a lot of other people are able to. And nowadays, you can push a button on the mobile phone that allows you to invest in these stocks.
Yeah.
So just on here, Mum's on. So Margot's on. So let's not swear, Jace, otherwise we'll get another angry face.
I promise I won't swear tonight, Mrs. Fenton. That's good, right?
So we're not allowed to swear. We're not allowed to swear. And Julie fucking Fletcher's on as well. So
that's her official name. That's her official name.
So for the business owners out there, and let's contextualize this, because we're not just going to wax lyrical. We'll make it important. And this, if you are a business owner or you're investing in businesses, I'm not going to sugarcoat this. You need to be listening to this right now. Absolutely, you need to be listening to this. And as an investor, you need to be looking for the opportunities and understanding the risks. Because in Australia, it's very, very similar in Australia as it is in the UK, as it also is in the US. We're going into an election year in the US, where typically they will spend a shitload of money just before the election, and the election is just about to hit, right? As a matter of fact, they're out there, they're campaigning. I'd say they're out there campaigning. They're in there campaigning, I guess.
Campaigning, yeah.
But let's look at it in Australian terms, because we're here, right? So JobKeeper. And we said some time ago that, and I can't write on this, so I apologise, but JobKeeper there, hopefully you can read that. JobKeeper, it's basically first version, we said it was going to be extended. It has been extended, but there are massive limitations on the extension, right? Now, it's still not legislated as far as I know right now. Check with your accountant. I'm not giving the advice here. But the way that we understand it is now, instead of qualifying for 1 month, you need to qualify for the quarter. So it's becoming more difficult to get it. And they're also stepping it down. Instead of 1,500, tier 1 is getting 1,200, as you can see there in the white down the bottom. Or you can't see in the white. You can see it under the December. I put it in the wrong column. Tier 1, if you were a full-time 80-hour per fortnight employee, you would get the 1,200 instead of the 1,500 for everybody. Tier 2 means if you weren't working to that level, you'd be getting 750, right? Whereas previously, everyone was getting 1,500 per fortnight. What this is a reduction of the amount of money that's going to go back into the economy, right? And back into business owners' pockets. So JobKeeper is being repealed, right? Slowly but surely. It's not just, it's still there, but don't let them bullshit you with their blah, 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 blah. It is harder to get. Less businesses will be able to get it. And as Jason and I have spoken about a few times before, there's a cash flow conversion cycle in business, right? And many businesses' cash flow conversion cycle isn't weekly. Like if you are a restaurant, it's daily and weekly. But most businesses have 90 and possibly 180 days. And here's the thing, most small businesses trade with other small businesses. So if you trade with me and I've got a 90-day cash flow conversion cycle, which means that I don't get the money for 3 months, and I'm trading with another small business and they've got a cash flow conversion cycle of 90 days, that's half a year before that money is realized. That's half a year before the lag on the economy comes.
The knock-on effect.
The reason why I bring...
Have a quick look at this one here. I mean, I'll put that there. I mean, this is exactly what you were sort of saying as well. Not only is the money that's going to go into the economy going to reduce, but the money that's already gone into the economy, most Australians are sitting on it, right? Right now, our savings ratio, we're not out there spending those stimulus dollars that have been, given to people in the marketplace. They're like, yeah, thanks government, but I'm just going to sit on that right now because you know what? I'm not quite sure what's going on. So this can be a two-edged sword, right, Andy? Maybe this will maybe everyone will be like, maybe next year, middle of next year, spending money like a drunken sailor. But for the moment, and this is plenty with plenty of my clients as well. They put their mortgages on pause. They've got extra money from the government, and they're squirreling it away. It's not going back into the system. It's like sitting in, bank accounts. We know they shouldn't be sitting in bank accounts, but they should be in offset accounts, gang, by the way. But, it's an interesting one, Andy.
And here's the thing is that savings doesn't necessarily mean savings. Savings can be speculative investing, right? Of which a lot of it has been.
Yeah.
The amount of, and so let me share with you a little anecdote that I heard of more recently. There was an app that was launched in the US called Robinhood, and Robinhood was this app that was a shares trading app, and it allowed you to trade in CDOs and other type of leveraged instruments. It's a sad story. I'm not 100% sure whether it's true because I haven't delved down into it, but I heard that a young man actually invested in a whole lot of leveraged instruments only to have the market fall out and have a $250,000 debt that he had to pay back. And so there was a life of a young man that was gone. So we're not just saving, we're actually using this for different types of investments. We're putting it into consumer goods, right? Because savings is not always a representation of, because the way they measure savings in an economic perspective is how much money is being dispersed out into the economy. But when it gets dispersed out into things like Afterpay and these post-payment types of utilities, and that can actually push the statistics out 90, 180 days into the future. So our statistical measurement.
Credit card, I suppose, too, Andy. Maybe you might have it in your possession, but using your credit card or something like that. Maybe
it's more when the retailers actually receive the funds.
Yes,
because that's when they report the funds, right? And so some of these delays, there's accrual and cash accounting, but probably getting a little bit too convoluted in it.
But you're right.
Here's the key thing is that for business owners, what you need to be doing right now is exactly what we told you to do 3 months ago. You need to be understanding that next quarter, you will pay BAS, you will pay GST pending a federal government. And here's where ScoMo can come in and save the day. He has certainly beat the living piss out of Dan Andrews recently, and I'll chat about that in a tick. I don't want to get political, but I am going to for a little bit. But as business owners, we need to be looking and going, okay, we have now got to factor in PAYG tax that we've had highly concessioned or we have not received, or we've not had to pay, and GST of the same amount, right? We are also potentially not going to be receiving JobKeeper. So not only are we not going to be receiving more money, we're going to have to pay more money. So everybody out there who's got a business, budget for that. So here is the investor talk, right? Because as a share market, we know this stuff is coming. And we also know that the banks are now going to potentially make people pay back some of their loans, right? And I know I've already had cases where people have been extended 3-4 months into the future, but that can't happen in perpetuity. So we now go into a period of time of uncertainty. And this is the thing, is that when you repeal stimulus, you create uncertainty. When you give stimulus, as in when the government gives you tax breaks and throws money in, the world goes, oh, the government will save us, which is fucking crazy, because when has the government really ever saved us? Like, seriously. It's
Andy, that wasn't me, Mrs. Fenton, that was your own son.
It was. So what's going to happen, and we picked it from the beginning, markets have started to become more turbulent, right? So the growth stocks in the US, so Tesla, Apple, Microsoft, the big tech giants have started to wobble for the first time. I think I've actually even got it in a bit of a prezzo here for you, where you'll be able to see it, just to give you a bit of an idea as to what's actually happened. And markets have only been going up and up and up.
Well, I mean, and you and I talked about this, 3-4 weeks ago, was, it made no sense in the middle of, weirdness, like, why would the markets be growing? But then, you were saying, well, why not those income markets or those income shares or, those income stocks or whatever it was were doing great, mate. Put a little video on, Andy, somewhere in the corner, top right, maybe. but it's always good to see, you know, a bit of correlation on, you know, really the marketplaces and stuff like, because really at the end of the day, we're talking about emotions, right? You know, it was something that you just said before. You say, oh, we're dealing with emotions. We're dealing with, you know, emotions in the marketplace. And, you know, what you said was the common person can now have an effect on a company's value, right?
100%.
And the common person doesn't have an emotional capacity or an emotional fitness, emotional or mental fitness about, you know, going the distance in business and, you know, understanding that this is normal and all those sorts of things. And it actually bloody brought me to a correlation in real estate. Like, this is the bloody same thing. You know, you get the good time Charlies who come along, you know, when the market's been going great for 3 or 4 years, and they're like, oh, we're going to dive into real estate. They pay too much. They pay too late. You know, they don't know how to structure themselves. And then, you know, at the first sign, the first like fart sideways of a problem, you know, they run for the hills and they sell their properties for less, or they sell their shares for less. And the uneducated, unsophisticated, fear-based investor, and I wouldn't even call them an investor. They're a bloody punter.
Speculator.
Yeah, a speculator punter. You know, ruins or has the capacity to have a pretty significant impact on the value of a business. You know, or, you know, on the value of a property, because, you know, they should never have bought it in the first place. So it just reminded me of the correlation there too, because, you know, it makes me cranky, the old good time Charlie who doesn't understand about, if you're an investor, you're going to buy something that's, you know, in my world, I'd love to have a rule where you buy it, you have to own it for 20 years. You know, it's so you know, you're not allowed to get in and out. Like, you know, wouldn't that change the market a little bit, Andy? But anyway,
or if you get in, you continue to get in, because this is the reality, right? So the company that we all love to talk about being Apple. If you have a look at this, and I've just obviously Googled the share price, but what they've done is basically from go to O. Let me see if I can actually do this. What have we got? 102,009. Let's call it 100,000% increase since day one. Now, of course, we see the most of that leverage between sort of 2008 and now, but the reality is, if you invested just constantly throughout that entire period, your average return would actually be somewhere in the vicinity of about 20% per annum. If you tried to get out, and this period between 1986 and here, so if you took these two periods, there are multiple movements while that stock price was lower, whereby you could have bought in or sold out at 80% gains or 80 or 90% losses. The company almost went bankrupt. So when it comes to investing, it comes to the psychology side of the equation of, yes, do I sacrifice what I've already got in? And the question I always ask when it comes for a sell is it worth selling because something has changed, right? Something has fundamentally changed. Or has it been market movements over this period of time that have driven you to sell that share?
Yeah.
And
I mean,
so
that comes to like a fundamental conversation you and I have all the time, right? You know, I don't believe someone should call themselves an investor because they own a share or a property, right? Like that's, you know, you're a punter until you're committed for 20 to 30 years. Then you can call yourself an investor. I think you should have to earn your stripes. You know what I mean? It's kind of like, you know, how dare you call yourself a business owner when you don't have any employees, you've got no overheads, and you sit at home and pretend that you're a business owner when you when you got $3 worth of Facebook ads, and call yourself a business owner. Like, are you kidding me? You know, the idea in my world is like, you know, for crying out loud, you know, you have to earn your stripes. And people who are emotionally unstable, mentally unstable as an investor are dangerous to all the people who actually, really are really taking.
Well, they
this
create great opportunities for people who are emotionally stable and investing.
Yeah, well, it's true, isn't it? You get to trade the noise. You get to trade the emotional stupidity of the rest of the marketplace, don't you?
And so here's the noise of the stimulus, right? I just want to draw a couple of lines across here, because the fundamental point I want to make for business owners, and I want to draw the correlation with equity markets, is that business has been okay if you haven't been in one of the sectors that have been decimated, right? And I don't say that, I say that fully understanding that it's been quite bad, but equity markets have been reasonably good across the board because it's been certain that the government will bail us out, right? So here's the attitude for, this is where COVID hit, right? This period here. The government will bail us out. Got to here. And this is the US. And now they've gone, will the government bail us out? Because now we've got Joe Biden, we've got who's going to tax, larger business. We've got a whole lot of stuff which is uncertain. And so let's have a look at that growth curve, right? So again, this is COVID, and this is a representation of the top 500 stocks in the US. This is the last month. And we haven't seen anything like that since COVID, right? We haven't seen this kind of month, which is negative. It's still got its bumps along the road. But let's have a look at that and go, well, is that in isolation? Well, it's probably not, right? It's a rhetorical question. It's a little bit different in Australia.
Here's what I prepared earlier. Yeah.
Here's what I prepared earlier. This was COVID, right? And this was the government will bail us out. Clearly, we are either not as stupid or not as enthusiastic as America, or something along those. I don't want to call Americans stupid or enthusiastic because they're not, right? But I think Australians are naturally a little bit more pessimistic. But
yes,
we also don't have the giant tech stocks of the US. And I think if we had the giant tech stocks of the US, we'd probably be up there.
Well, yeah, right. I mean, because the mining stocks, and like you've said before, we've got mining. What else? We're a big hole. The world digs digs a hole in for minerals, and we do a lot of farming. What else? So it's interesting, isn't it?
So we're not tech driven. So probably a fair representation. And even though we're negative here, have a look at the growth. And I should have actually put. We've basically from here to here, we're talking about a 30 to 40% increase.
Yeah.
But then we have a look at the last month and we go, the market's starting to shake again. And so what has been the key thing that's actually happened through this period of time that's led the market to shake a little bit? Well, economically, very little has changed other than these things and these things. And these things are called stimulus. This is the tax relief. This is the market boost, all of these different things, right? And what I'm illustrating for this for business owners is to be very, very careful about their cash flow management right now. But also as investors, this provides an incredible opportunity to sit there and go, okay, the government at the moment is not switching on the tap. Dan Andrews hasn't switched on the tap. Dan Andrews has given the biggest stimulus package that Victoria's ever seen, which is far less than what Victoria needs and probably mistargeted. But I'm not going to get into a political discussion. But here's the thing. We're over 12% of the whole GDP of Australia. We've got a budget coming up, but between now and the budget is uncertainty. And markets don't like uncertainty, because if you could buy and sell a property in 30 seconds and not realize, have to get a new loan and do all of these sorts of things, you probably would do that. So the difference between property and the difference between stocks is that in property, people can't transact as quickly and can't freak out and get out as quickly. But what we're going to probably see, and I can't say guarantee, but what we've already started to see is a bit of unsurety in the markets. We're a bit unsure as to where things are going. So we're going to see more negative returns over the medium term. And where those are coming from is from all of the tech stocks. So they're coming from stocks like in the US, the giant caps, right? Where they're coming from the Facebooks, the Amazons, the Googles, because the world's not quite sure whether Donald Trump is going to be able to stimulate and do as well, right? But here's the thing. The banking sector, even though they just came back around and said that they may force the banks to cut dividends, banking sector's slightly up, energy sector's slightly up, material sector's slightly up. And this is where it comes from. Are we going for growth or are we going for forward-looking cash flow models?
Yeah. And
and
you
this
and I
is
talked about before, haven't we? Like, we talked about, and, the obsession with growth, is an interesting one, isn't it? Because you don't really get to benefit from it until you sell the thing that you own. And it's a weird thing, isn't it? It's
intangible.
Yeah, and intangible. I call it in the real estate game a vanity metric, right? So like you're sitting there and your property's gone up in value, and you're like, oh, I can tell everyone at the barbecue, right? But really the metric you want to measure is you bought the property with a $25,000 a year rent, and now 10 years later the rent is $50,000 a year. Like, that's the metric,
And that's where strategy is important, because it's what do you do with the money along the way.
Yeah,
right?
Yeah.
And the amount of barbecue talks that I hear about like this, I bought Bitcoin at $1 and I made $1 million out of Bitcoin. Oh, really? What did you sell it at? I sold it at $2. Do you know what I mean? It's like, I was a millionaire, but then I rode it all the way down.
That I was. But, a couple of things in my end of my neck of the woods, Andy, this is an interesting one for me. And, for, the real estate game, I think, you and I were chatting just before we started, Westpac's making some interesting claims about future growth of property values in Australia. And we'll play around with this in a minute, because this is what I'm sort of leading up to. So, the biggest gap in decades of rental yield versus government bonds, and money is looking for a place to earn some dough right now. It's a very interesting one. And I think I said this last one in Wisdom, but I can't remember. But I sat in a meeting where there was a family office who managed, over $1 billion worth of funds, and they're looking for places to get these funds working. I had another conversation today with another investment company who has a product where they will fund a 5% deposit for people. If you've got a 5% deposit for a property, they will lend you the other 5%, and you can pay it off over 2 years. Man, there are some alternative lending products out there, because cash, cash is seeking a place to get a return. Right now, if it's sitting in cash, it's devaluing, and it's a crazy time out there in the marketplace when it comes to investing. Certainly, real estate smells pretty good, to be honest. This one was absolutely cracking, and it was kind of like listen, I told you so. I told you this. I've been saying this for months, you lot. Would you listen, for crying out loud? I mean, really, if you have a look at vacancy rates around Australia, let's have a look at Brisbane. Over the last year, Brisbane's vacancy rate has decreased. Perth's vacancy rate has decreased. Adelaide's vacancy rate has decreased. Canberra's vacancy rate has decreased. Darwin's vacancy rate has decreased. And there's only 2 places in Australia that vacancy rates have gone up, which or 3, but over the year. And only slightly, very slightly, Sydney's vacancy rate from a year ago has gone up just a point. And then, Melbourne's vacancy rate's gone up a little bit. Darwin's vacancy rate's gone up a little bit. Oh, no, sorry, Hobart's vacancy rate's gone up a little bit from 0.6 to 0.7, So, Andy, with the media and the carry on malarkey of like, oh, the world's going to end and no one can pay rent and everyone's leaving and stuff like this, it's absolute bullshit. Oh, excuse the French. But this is where
I'm there with you, mate. And what if people really want to look to a reference point of this, start to read text in and around, well, scintillating stuff, Andy, but this is what I do: read text and read books in and around the time of World War II and coming out of it, because what actually happened coming out of it was significant. What happened in the throes of it was obviously significant, and I don't downplay that. But what we're talking about is economic response to economic austerity or economic recessions and depressions. And when you look at these sorts of stats like you're showing, and here's the caveat, is that you've taken out a metric, haven't you? You've taken out interest rates.
But it's very difficult to make interest rates any cheaper, Andy. Like, I mean, unless they go into like, all right, let's just give money away for free. Let's pay Andy to borrow money. I mean, in some countries around the world, that's the case, isn't it? But
England's thinking about it. It's hot on the possibility for the Brexit sort of scenario over there. But everywhere in the rest of the world has realised that it hasn't worked.
Well, mate, have a look at these sorts of things here. I mean, this is just Brisbane, and this is only one example of the supply chain, which is absolutely, poleaxed. Brisbane from a high of 11,000 properties in, of completed properties in 2017. It's as of today, its trajectory is 500 or less properties, because if you have a look at those green parts, you have a look at the color code there, right, Andy? That's possible. There's possible and likely, and more likely, it's on a one-track place. Both Melbourne, Brisbane, Sydney, and Canberra, because of COVID, and actually, it wasn't even because of COVID. It was actually because of APRA. And APRA's borrowing tightenings prior to COVID. COVID's just finished it off. Right now, it is so difficult for developers to get any project off the ground because of the limited borrowing capacity of investors, right? So first-home buyers are cool, but first-home buyers don't buy off the plan. First-home buyers don't, by and large, buy new properties. The supply chain is absolutely poleaxed in Australia right now, and the shortage of properties is the worst supply chain, approval supply chain in Australia's recorded history. And I've been saying, I'm pretty sure I've been winding this one up for ages, right? And it's been coming, and COVID's just made it worse, but it was coming before COVID, right?
I get it. But here's what I keep hearing, and my response to it is, but Andy, we're in a new normal, which, by the way, people should take that term, stick it exactly where it doesn't fit, because it doesn't fit here. There's the new norm. Was there a plague once before, Jace?
I'm pretty sure there was a few, actually, Andy.
Was there famines? Was there austerity? Was there dictatorships before?
Totally.
And they actually wind out. And this is the evolutionary, but it's also the symbiotic nature of how we evolve. Short term, yes, significant disruption to the way that we live. We get on the other side, yes, significant disruption to how we used to live, because we live in a new sort of paradigm. But the reality that some people are talking about at the moment, and they're saying, well, Andy, it's all going to go to large vacant land out in the hills and large vacant land out in the... And the reality is that we're a big country, but we ain't that big, right? It's like not everyone can have a massive vacant
not
lot.
That big, Andy. When you think about it right now, and we were doing this the other day, we did a presentation. My business partner Sam Saggers, mad researcher in this stuff, has been talking about the live, work, play triad for value for a long, long time. Livability for you as a owner occupier, somebody who wants to live in a property, either rent or owner occupier, you don't want to be caught in traffic. Like I believe, the house and land package 40 kilometers from the CBD is actually going to be the new slum zone for the future, right? It's actually going to be cut off from infrastructure. Governments have no capacity to continue to endlessly sprawl infrastruccture endlessly into what's going on?
Just Googling how far I am from the city centre.
How far are you? 42K?
I'm 48 kilometres. I'm done for.
Are you done for? You're a weekender, mate. You're a weekender location. That's where you are, mate.
Mate, we get 4G if we even get a G. You know what I mean?
But at the end of the day, right now, COVID's actually been a really interesting gift to the medium density living world, where right now people are like, I don't have to travel as much. I can work from home 2 days a week and maybe go to the office 3 days a week. Those places where people were considering like, oh, maybe I'll move to the country. This type of living has actually, potentially been redesigned in a very interesting way. Listen, I think the medium density living is going to be redefined as more attractive than ever in the right buildings and the right locations. And certainly, certainly the young professional, does not want to live in a regional location. They don't. I mean, there's no infrastructure there. There's no coffee. There's no nightlife. There's no nothing. It might be that, someone retiring, but certainly the predominant professions certainly require people to be close to a city, and certainly are still going to require their teams to have participation in a physical way. We've seen that in a bunch of professions. I think it's an amazing rebalancing of how we work. I can't clearly see how it's going to work, but big offices still want their team to be getting together once or twice, 3 times a week. I don't know how that's going to look, but they need to be close enough to be physically interacting in some way, shape, or form. It's a really interesting conversation that I don't have an opinions firm yet, but it's one that's unfolding.
I've got two that are diametrically opposed. One is in the property space, and I'm not a property investor, that's your game, but I fundamentally believe that there'll be fractional ownership, and stamp duty and capital gains tax will be kicked on its ass based on how the fractional ownership of property will be. This is 10 years from now. In that, Jace, you and I, we're going to go hard at it. 5 years in the city centre. We're going to hit it hard. We're going to hit Melbourne hard. And then we're going to take a stake in a beautiful farm out in Mansfield, and we're going to go skiing for a few years with the family and enjoy the lifestyle out there. There was a circumstance that happened just recently in Airbnb that was publicised in Australia, and I think that this is how this is going to unravel. In that you don't rent a property, you temporarily own a property, because that takes care of all of the insurance, all of the various different components. So your insurance policy will travel with you to different policies, and this is the blockchain world that we will then live in, right?
You and I have been about this for a while, haven't we? Like, once you take away that friction of that changing, like when that happens, and it's coming. I mean, you and I both know it's coming.
Well, once you get the government snout out of the profit trough, which they don't participate in, and you allow a free market trade of the underlying asset, like buying a banana. Yes, they get their GST. Take the GST, I don't care. All right, take the GST. Just have one tax. Don't have many taxes. Just have one tax.
Mate, they bloody brought in GST on properties, and they were meant to get rid of stamp duty. The whole gig was, mate, GST came in and stamp duty was to go out. And it's still there, bloody buggers, And
this is the thing, because you could quite easily transfer, right? You could transfer property rights between people quite freely in order to be able to exchange lifestyles, exchange real estate, exchange all these things. We have all of the mobility factors and we have the capabilities today. We just don't have the taxation that applies to being able to make it happen. But to me, that is the future, is that we can quite easily, because the only thing that stops us too, and the beauty about Airbnb, the beauty about Uber, the beauty about these companies is that they will destroy government policy.
Well, they interrupt it, don't they? I mean, I've got a client, Andy, right now, who owns a property in Broadbeach in the Gold Coast. They purchased that property. They live in it 9 months of the year. They own a van and they travel 3 months of the year, and they Airbnb that property out for 3 months of the year. That 3 months of the year that they Airbnb that property, right now they're limited for Airbnb, but previous to the COVID world, their 3 months of Airbnb their property, which they were living in a van and having a fun holiday, young couple without children, by the way, the money they made over that 3 months paid their whole year's entire mortgage for their own home. Maybe.
So why would it go? What is the impetus, or what is the wall that stops it from paying for the property that you live in, other than it being owned by the government, paying for the property that you live in, regardless of where you live in it? So if you live in a caravan, then you live in the caravan. You rent the caravan from the RV person, that's X amount of dollars. Why couldn't you then become the fractional owner of that property, which means that you're responsible for every damage that you do to that property, and your insurance company is liable to you, not to the property owner? And this is what we're going to see. And mark my words, we're going to see it, Jace, because I know insurance companies better than most people, right? Because insurance companies they're actuaries. They work on statistical probability, and I love that stuff. And what they don't like is, well, statistically, if you rent out your property to some bozo who could possibly put a keg through the wall, then I want to charge you more insurance, but they don't have the mechanism to do that right now. But if your insurance travels with you where you go, and you have fractional ownership, so rather than the Airbnb of the world, that you actually transfer the ownership of your pool into to where you sit. I know it's an abstract conversation, but I honestly believe that in the next 10, 15 years, we're going to start to see assets be put into a pool, and structurally, it's already possible. Let me blow everybody's mind with that. I don't know how many people are looking, watching at the moment, but structurally, it's possible that we could all put our residents into a pool that would facilitate a fractional ownership of what we do in a way like that. The only problem that we would avoid is land tax. But anyway, let me not get into that in the public domain.
There's no such thing as avoiding, Andy, but it is minimising, right? Legally minimising land tax. So
it's just, it doesn't operate in a collaborative environment like that, because they're not seen as it's the titling aspect of it, which is really interesting. But my point being is that we're going to get to a. Sorry,
I mean that stuff's been happening for a long time, right? The world has known it as that holiday letting where you'd sort of buy into timeshare, right?
Timeshare, yes.
Yeah. So, it's got a terrible reputation, but if you took that idea, which is there's a legal framework already for that stuff, and you then had that as because I've seen this quite often actually, and it's not, instead of timeshare, which is a little bit cheap and cheerful, high quality timeshare as an individual. I was offered 2 or 3 positions in a worldwide timeshare in some extremely amazing pieces of real estate, 22 pieces of real estate that you became an owner in, and basically you set your calendar for the year, and you got to live between 2 and 4 weeks in each of these properties in a rotational basis. And it was amazing. It was attractive. It was probably 10 years too early for me and my family, probably still 10 years too early. Probably in another 10 years, I'd entertain the idea. But mate, exactly what you're sort of saying in this sort of space. You know, this world, the world of, it's interesting, the world of the experience you want to have in where you live and have fun is different. Now, Andy, what are we playing here? Pictionary? Is that a palm tree, a house, and a car? Is that a beach, a house? Last time you did this, you drew something phallic.
That's why I was careful about the palm tree. So some of the biggest companies in the world are insurance companies. But the problem is that insurance companies were able to make great profits and great returns because they would judge risk based on statistics, right?
Yeah.
Which is, what is that? And if you always win, what does that make you?
Like a winner? I don't know. Like a casino. I was going to say, sounds like I'm at the racetrack of the casino, Andy.
Totally, right? But one of the things that came in is legislation that basically says if you're going to insure people, well, we want you to make sure that you can pay these buggers out. So you need X amount, which is substantial, invested in fixed interest.
Right.
Now, we know that fixed interest has done nothing but that down to now 0% over the last 30 years.
Where do they put their money now?
Now, when you take into consideration that the insurance companies are some of the largest global companies in the world and are backed by some of the biggest money in the world, well, you think, well, how does the insurance company re-engineer itself? So here's my thoughts on how an insurance company re-engineers itself. You are Andy, me, allegedly me, as an adolescent, right? Do I have a good driving record? No. Have I owned a house, or are the last 3 houses that I've rented been in good positions or bad positions? They've been in bad position. And did the last time that I went on holiday, I set a fire on the beach? There's a higher probability of smoke, right? So instead of an insurance company looking at the car and insuring the car for somebody of my age, which might have been 25, and saying, oh, there's a 25-year-old owner of that property and their travel insurance, well, he has a platinum card, let's just charge him the same old rate. So let's just flip and go, where are insurance companies thinking about this stuff today? They go, well, we know that Andy is notoriously a bit of a fuck up when it comes to cars. So he's a bad risk, right? So how much are we going to charge him for that insurance premium on the cars? We're going to charge him a lot. But as a house owner, he's actually very, very good. He's got 0 claims. So he's going to be a 0% average above what we would normally charge each other. But when he goes away, he is what we call super high risk, right? SHR, super high risk. So when this dude goes traveling, he's going to get a 75% loading. When he owns a house, he's going to get a 0% loading. And when he drives a car, he's got 1,200% loading. And this goes back to what we were, because this is how markets, and by the way, this is not based on any knowledge of any insurance company. I don't want to put that out there. But when we talk about a world where interest rates get to 0 and we have companies and markets and businesses and worlds trying to adapt to the fact that borrowing money has hit a 0% barrier, then they need to find out different ways in which they can actually price risk. Yeah. Right? And risk is, what do you need to be rewarded for an investment? What do you need to pay?
Right now, like literally Lloyds of London is underwriting the 5% deposit scheme that I was talking to you about earlier today. I think I started mentioning it earlier at the start of Wine and Wisdom, where Lloyds of London will, if you have the servicing, they will lend you the 5% for you to buy an off the plan property. So they'll lend you 5%. You've got to save 5%. So you can buy a property because you've got to put down a 10% deposit. Lloyds of London will lend you 5%, and you can have a payment plan to pay that deposit off over 2 years. The developer gets the full 10%. So he's allowed then to count that as a genuine sale on his contract. He can raise funding and finance so he can move forward on his development. Lloyds of London are charging you 8% on lending you 5%. So it's a very low cost loan. You end up with a credit rating by the time you end up, paying the 8%, and everyone's a winner right now. That is a product, Andy, from Lloyds of London right now, and they have approached us at Positive Real Estate to distribute that product to our investors and our property buyers because they're looking for places to put their money. It's crazy. Like, it literally happened in the last week, and you're saying, all right, what are these insurance companies looking for? Because they need to make that money go to work, right? It's a bloody interesting conversation right now, that's for sure.
Well, you look at if you just break this down a little bit, you go UK. What are the and Lloyd's obviously being a big UK company. What are the risks of the UK? And actually, UK has been pretty strong. The pound's been reasonably strong. Well, Brexit still hasn't been solved, right? Still, Boris has done fuck all for about 5 or 6 years, but we can't blame that on just UK politics. We really have done fuck all here as well, really, since Howard, probably, if we're to be fair, Liberal or Labor.
I miss Johnny, but anyway, let's not talk politics.
So we go Brexit, right? Risk. Is it a risk? It's a massive risk, right? COVID-19. Do they have massive cases? Yes, they have massive cases. Do they have political stability? Question mark.
Yeah.
When they look to Australia, they assume that we have political stability. That's because they don't live here. But do we have lower numbers of COVID cases? Yes, we've got lower numbers of COVID cases. I'm just taking the piss out of politics, by the way. I'm trying to be funny, but nobody's laughing. Do we have an international trade tariff, or do we have a massive potential of restraint of trade? Well, potentially with China, but the reality is we've got a soft government saying no. Do we have massive amounts of land, and do we want imports of people? To me, that's a big tick. And you've said it before, and the government have made it clear that when this stuff ends, right, when this ends, we are going to go on a recruiting drive of a lifetime. And this is going to be recruiting from nations all around the world. And when you think about how the world is, oh my God, I just threw up a little bit. When you think about how the world is actually responding to COVID, and when you think about how Australia is responding to COVID. So how's Australia responding to COVID? We're going north of the border. How is the Northern Hemisphere going to respond to COVID? They're going to go south of the border, and they want to go to a place where it is the impact of this stuff is minimalized,
yeah,
or contained to a degree. They want to fly to safety. People want to fly to safety. Money wants to fly to safety. And as weird as that sounds, given everything that we've just said, is that if I bring that back to Lloyd's, subsidising home purchases in Australia, you'd have to go, when they're weighing up their risks as putting lender mortgage insurance on their British citizens in an overpriced market in the middle of COVID and Brexit, as opposed to going, our pound is quite high at the moment, we lend it to Australia and into the Australian economy where these risks don't exist. It seems to be a fair risk exchange matrix, in my opinion.
Well, they're probably, they're certainly smarter than me, Andy. I think you're a lot smarter than me in this space, mate. But those places, research their marketplaces fairly well, and they can see the Australian government has got, runway for stimulus. The Australian government stimulates the construction economy. It's kind of like only a one or two trick pony, unfortunately, with the Australian government. But, at the end of the day, that's what they're doing. And it seems to be working in that sort of space. So, Last but not least, and I think we'll leave everyone with these last couple of thoughts, Andy, but here's one that you and I were chatting about earlier today. Westpac came out, Bill Evans, he's quite renowned in the world of economics, and said, well, you know what, instead of, Andy, share your screen, share your article.
You've got to allow me to be host, but let me see if I can get it. I'll
do it. How do I make you host? I know how to do that.
That's all right. I'll find it for you, mate.
Here we go. Make you co-host. I'm going. There we go. Make you a co-host. Andy's got the interesting flip side to this one, where CBA and NAB reckon, okay, the property market's going to fall. There's all these problems and risks coming, which right now, which is unproven right now. The lenders or people taking their properties off of mortgage pauses are very simply going back to paying those mortgages, because most of them pause the mortgages under being conservative, not under being under stress, which is actually very interesting. And we said that to a lot of our investors: if you're in any way affected, pause the mortgage, screw all the cash. That's what we said, because we don't know what's coming, and that's what a lot of people have done. So right now we've got, people saying, oh, we think there's troubled times ahead. And then we've got, the Westpac saying, well, hang on. Since we looked at it, since we realized that the supply of property is the worst we've seen in Australia's entire history, since we've seen the interest rates are the lowest in Australia's history, since we've seen that the stimulus for first home buyers is the highest stimulus in Australia's history ever, we reckon there might be some legs in some of these marketplaces. So, it's interesting. I'm a massive, I 100% believe in Brisbane and Perth. I don't know about that much, but to be honest, I can see it on the ground. 300 pieces of land sold in 1 month when with one of our suppliers, when their regular month was 30 to 40. Andy, that's 10 times their regular month in the middle of COVID. Dude, that has consumed 6 to 12 months supply of land in southeast Queensland in 1 month.
Let's add a few layers to that though, Jace. And so I'm actually really bullish on Queensland property, and if it doesn't rise soon, I'm going to be getting in. But here's the reasons, and I'm not trying. And this isn't go by Queensland property by any stretch of the imagination, but this is an anecdote of when I first got into financial services. When I got into financial services at the tender age of 20.
That was a long time ago, Andy.
It was a bit over 20 years ago. Where I was going to go was Tasmania, because a lot of the hubs of Macquarie Bank and other banking sectors, a lot of the call centres and a lot of the pedigree, or not the pedigree even, it's just like the Slumdog Millionaire. If you wanted to start in the bottom and work your way to the top, you went to the bottom, and the bottom was in Tasmania. And it just so luckily changed from Tasmania to Brisbane because Brisbane hit the skids. And so everybody moved from having offices from Tasmania to Queensland, because it was so much, the cost affordability, but the lifestyle increase, unparalleled.
That's why I moved from Sydney to Brisbane or the Gold Coast, because the incentive and there was payroll tax incentives, the whole thing. Yeah, totally.
So now we've got a different.
Jace Lane Gate was giving me a bit of cheek about drinking water. Sorry, Jace, I've run out of wine. I realised I only sort of got half a bottle. I should have got some more. So, mate.
Mine's out of a Teskey glass as well.
Oh, mate, We've let the team down, mate. We didn't prepare well enough. But Andy, mate, I think that gives us a bit of a chance to sort of put a pin in this week's Wine and Wisdom and maybe leave some of this discussion for later next week, and letting everyone know that we might be moving to the YouTube live platform rather than the Facebook live platform. We'll let everyone know what we're going to do in the coming weeks with that sort of stuff as well. But it's been great to chat with you again tonight, mate. I'm super pumped about getting into the equities market, and I know I've been revving you up a little bit about getting into the Brisbane property market as well. And we'll leave everyone with this. This is the one that I'm hoping to pop Andy Fenton's cherry of his first property investment interstate in Brisbane, the proposed greenest building in the world, over 2,200 plants. All the grey water is recycled. There's solar on the roof, etc., etc. Unbelievable. And that this will be in Brisbane. And so I'm chucking it out there. I'm pumped about buying some shares and getting into equities for the first time in my investment life. And I'm trying to edge Andy over to buying a piece of real estate, investment real estate in a marketplace that I love too. So guys, keep an eye out for these two things happening in the next 3 to 6 weeks. Certainly the equities market will be in there a little bit earlier than the property market, but a little bit of juicy news for all investors. It's a garden in the sky, dead right, Shay. It's a pretty cool building. But brother, as always, insightful, fun and interesting to hang out with you on a Friday. My glass of wine is empty, sadly, and so is yours. We need to be better prepared next Friday. Thanks everybody for joining us. Nicole, Jace, Michelle, Shane, Emily, Christopher. At my end, who we got?
Julie said, you've done my head in again, guys. So, so I guess we tick off that as part of our objective for the night, Jace.
Tick the box off, yeah, exactly. Jules, great to see you. Julie fucking Fletcher, you're an amazing lady. We love you, and thanks for joining us, all of you guys, tonight. Also, so all right, buddy. Well, you have a good Friday, and for those who dialed in tonight, thank you for dialing in, and awesome to see you guys again.
Just one thing to leave everybody on: be strapped in, be aware. Don't listen to the bullshit news. But just understand, in times of uncertainty, look for a reasonable source that holds you stable. Don't get wrapped up in what's going to happen, because what's going to happen over the coming weeks is going to be a whole lot of horse shit. And just try and see whether you can see through it, and reach out to me, reach out to Jace, reach out to other people that are within this thread and within our forums, because there's going to be extraordinary opportunities that'll come up from the varying degrees of uncertainty. And there is uncertainty at the moment, and it's a matter of finding the certain within the uncertain, and that'll give you a little bit of light and guidance. And if you don't know, ask, most importantly of all. And
we're always here. Yep, hit us up on Facebook, send us a message. Always happy to help, gang. Absolutely. All right, that's it. Done and dusted, Andy. All right, thanks, team. Have a good weekend.